Yeah, good morning, everybody, from my side. As Ian just said, my name is Dominic. I'm heading the research division at Bitcoin Suisse, and I'm very excited to share our recent insights and analysis on digital assets. Would you mind putting up the slides, please? Okay, thank you. So the presentation today, we title it Redefining Strategic Anchors and Why Digital Assets Are Becoming Fixed Points in Institutional Portfolios. As you know, we are currently dealing with a debt loop in the US and other nations. At the same time, we have a major hard asset rotation that we observe. And in terms of legislation, we see that digital assets are becoming increasingly relevant. And this also translates into portfolios. Today, what we do together is basically outline why the risk-free rate isn't risk-free anymore, which smoothly segues into why the current era basically forces you to own real assets. It really matters. And then we do some specific cases and arguments for why Bitcoin is a really strong portfolio contender and why ETH is a really strong portfolio contender. Obviously, in that presentation, we focus on the large caps. There's also like major opportunities outside of these two digital assets. We start very high level with the global debt to GDP map. What we want to highlight here is basically that across many nations, we see an increasing debt spiral, basically highlighting that many countries are running hot on deficits. If you check the map, the more red it gets, the higher is the global debt to debt to GDP ratio. We see that nations, including Singapore, Japan, Eurozone countries such as Greece, Italy, or France are running really hot on their debt to GDP ratio. And most importantly, the US is joining the fray right now, inching closer to 130% of global debt to GDP, which historically is very relevant since it often marked a tipping point into devaluation, restructuring, or even outright default. So this is highlighting somewhat. You can also take this as a sovereign debt risk map, and it's in particular dicey in the spot of the US because they also issue the world reserve currency, as you know. By the way, China's total debt, so government debt plus other debt situation from corporations, for instance, is also inching closer to the 300% level. If we dive a little bit closer into how does the debt situation look like in the US, what we see is basically there's a huge divergence happening since 2020 with the onset of COVID. What we want to do in the next couple of slides is basically paint a picture of decoupling, decorrelation in very key metrics, and this kind of notion of there's something breaking in the system right now. So how you want to read this chart is basically the blue line is showing the federal debt position of the US. The red line is the 10-year treasury yield. And what you see, we start in the 1980s, we have very moderate debt levels. At the same time, the yield was quite high on the 10-year treasury yield. But as we move on across the last couple of decades, the absolute debt levels went higher. But it was convenient to manage that debt position because we had ever declining bond yields, right? So you could basically refinance your larger debt positions at ever declining yields. This is nice if you want to manage your debt structure. However, with 2020 now, you see that something broke in the system. Now we have like rising yields and the absolute debt load is crazy high. It's at 37 trillion right now. Meaning now if the US government needs to refinance their debt, they need to refinance at structurally higher yields, right? Meaning now there's something exposed in the system. For instance, the US is paying now more interest on their debt than on their defense, for instance, which yields like very compounding fiscal stress. We see like easing on the front, fiscal stress in the back, and it leads to a form of sovereign debt trust erosion. Another metric that is diverging heavily right now is the dollar is weakening while the yields are rising. If you think about it, this is not supposed to happen. If you have like a high bond yield, what investors are doing, they flock into bonds. They have to buy dollars first, increasing dollar demand, and buy bonds, meaning that the dollar should not weaken while the yield rises. And then the third metric where we see a huge decoupling is gold. You know, we are currently in a kind of a gold rush, and the correlation to the 10-year real interest. It's a little bit tricky to read that chart. The 10-year real interest rate, it's basically the 10-year yield minus your inflation, and it's displayed in an inverse relationship. So to explain it briefly, when you have high real rates on bonds, you are very happy and very comfy sitting in bonds. If the real rate is low, you with your capital, you seek different venues, among them gold. So meaning when the rate is basically low, gold is pumping and vice versa. This is not happening anymore. We are now basically like inching close to the 2% real rate, but gold is pumping. So investors demand more compensation. The trust is eroding basically that rapidly that they are rather holding a non-yielding metal than funding the government at 4 to 5%, implying a major confidence crisis in sovereign debt. So the high real rates typically discourage gold rallies, and this inverse link is breaking right now for several reasons. There's central bank demand for hard assets such as gold. There's increasing uncertainty when it comes to inflation. And we have that weaker dollar dynamics that outweigh the yield dynamics. So the take-home message basically is there's a major shift in investor behavior away from dollar debt instruments into hard assets. This also translates to central bank demand. Here we displayed basically the demand of the BRIC states. It's really important in particular because the BRIC states now overtook the G7 by GDP based on a purchase parity, meaning that these are like very economically relevant states, and they are like diversifying out of US-based assets and into gold. If we look at the 10-year picture of basically what asset class did yield which returns, we highlighted earlier that the debt pillar of the US is increasing at a very high pace, meaning across the last 10 years from 2015 to now 25, the debt pillar increased from 19 trillion to 37 trillion. At the same time, basically Bitcoin went from $300 to 110,000, and gold went from $1,000 to now trading around 4,000, meaning trillions in dollars are basically fleeing into the orange and golden lifeboats. In this chart, we display the total inflation-adjusted returns across this time span. And what is really outstanding in our view is that, yes, precious metals yield quite a decent return, but we needed a new axis for Bitcoin because it was like at 33,000. And then the interesting aspect is if you held cash or long-duration treasuries, you went out basically with deeply negative returns. In cash, you have had minus 27. In long-dated US treasuries, you had minus 41 despite the coupons. So this is kind of showing you that we might need to revisit the 60-40 portfolio. Maybe the bond allocation in the 40 portfolio isn't really fitting the zeitgeist, the current era anymore. And in our view, we will see like more hard asset rotations into gold and Bitcoin because these assets benefit from this trend. Now we are like basically heading into the pure Bitcoin part because Bitcoin resonates with all of this hard asset rotation narrative. We start a little bit with a relative basically perspective on the global asset landscape. And as you see on the left-hand side, Bitcoin is just 0.2% of the global asset landscape, implying to us there's huge upside in terms of adoption, in terms of price performance, in terms of market capitalization. And on the right-hand side, you see gold is leading the assets by market capitalization by a huge margin. Just recently, we crossed 30 trillion for the first time in history, and it's basically 10 times bigger than Bitcoin. Silver is bigger, and then even just vanilla single major tech equities are also like still bigger than Bitcoin. The picture we want to paint here is that on a relative basis, Bitcoin is still quite small. If you just think about this global asset landscape, in our view, this will change dramatically across the next 5 to 10 years, where we should see like large tailwinds into gold and Bitcoin. If Bitcoin just manages to go from 0.2% to 2% across the asset landscape, we are already talking about millions in Bitcoin valuation. Another very important aspect is if you think about the adoption from the institutional side. A recent survey from Bank of America showed that fund managers only allocate 0.4% into crypto. On the global portfolio side, we have 1%. And you know that the big financial giants such as BlackRock, Morgan Stanley now recommend like 3 to 4 to 5% of allocation into Bitcoin. So even there's huge upside in terms of institutional allocation flows. And then we have this notion of the great wealth transfer. I saw recently Franklin Templeton released that 94% of crypto buyers are in the age range of 18 to 40. At the same time, the baby boomer generation holds 50% of the US wealth. By 2045, most of that wealth will transition into younger generations that resonate way heavier with digital assets. Very important in terms of portfolio perspective, for everybody thinking, how can I enhance my portfolio? You want very good performance, you want very good risk-adjusted returns, you want diversification, and in the best case, you want a low volatility profile. Bitcoin, in our periodic table, basically shows its performance track record is unmatched in financial history. You see on the top-hand row, it shows you the best performance across asset classes, and you see that almost all of these columns are red, meaning Bitcoin in that year managed to outperform every other asset class. It yielded across from 2013 to now 100% annualized and 900,000% cumulative. The most interesting column in my view is the right-hand one, because you see it's a dynamic that did not happen so far. There was no bull run yet where gold outrun Bitcoin. And there's a good chance that this column at the end of the year might look familiar to the other columns. Diving into the recent gold run, and then we head back into the performance narrative. I just wanted to give some perspective on the gold run right now. Since the largest gold ETF launched, or since the gold inception in 2004, gold performed so well in the recent weeks that it overtook the S&P 500 ETF, even if we adjust it for dividends. So the gold run is really like very, very strong. And it already translates from Wall Street into Main Street, as we see on the right-hand side. There are literally physical queues outside of gold retailers. What does that tell us? The risk is elevated in gold. We have a proprietary risk metric pictured on the bottom of this chart. In black is the gold price. And what we see is basically, yes, there's a lot of gold demand and it might have some traction, some momentum left, but there were only 5 times across history where our risk indicator flagged a flat 1. And it was 3 of these times, it was like prior to the cycle top of gold, and 2 times it actually marked the literal top of gold. And we are now also at a 1, highlighting that you might be somewhat late to this gold rally, and Bitcoin might be the more compelling argument if you look into hard assets. Same thing, or same story if you look at the Bitcoin growth trend. We see in red it's Bitcoin against gold. In black, it's Bitcoin against dollars. In black, it's Bitcoin against gold. And what we see is that Bitcoin right now, in terms of gold, is really compressed towards the lower bound of this model, meaning that right now the long gold trade is already like heading into the retail part. A lot of gold is into traders' pockets, and on the Bitcoin side, we had a more measured cycle. We have a relative undervaluation in terms of gold, and it paints a picture of Bitcoin basically being the more compelling allocation or the more compelling asset in terms of the hard asset rotation. Another very interesting aspect is if you think about portfolios and think about the recent gold run, you know that portfolios are now overweight gold, which primes a rebalancing into other assets, right? And if you just take 1% of gold rotation into Bitcoin, we are already talking about 300 billions in fresh capital rotating into the digital twin. Back to more performance-heavy arguments. Here we wanted to highlight how Bitcoin also managed to outperform the Mag 7 across basically whatever time frame you want to pick. The way you want to read this chart is you pick one bar here, 2018 for instance, and until now, 25, Bitcoin yielded a 7.9 return, while the Mag 7, the most performing tech equities, yielded a 4.8 return. And you see, whatever time frame you pick, the red bar is always higher than the black bar, meaning that Bitcoin not only yields better returns than the best performing tech equities, it also comes with a better risk-adjusted return, it comes with a better volatility profile, and most importantly, it comes with a better diversification profile. The volatility argument is also incredibly important. This chart basically in the red line shows you, and the slight red channel shows you how volatility is compressing, mostly stemming from institutional flows right now, because these tend to moderate asset price volatility. You can think about more sophisticated market actors. You can think about rebalancing effect. You can think about options markets or just a passive tap into this asset class, which now compress the volatility below major tech equities. So in our view, this volatility argument that, for instance, Lagarde keeps pitching is outdated right now, because Bitcoin now behaves like a maturing asset and is actually like offering a better volatility profile than some of these tech equities. On the diversification front, here's a matrix of correlation metrics across different asset classes. This is a 12-month, so on lower time frame, the correlation is obviously higher. We see some form of correlation to the Nasdaq. Bitcoin is still perceived somewhat as a risk-on asset. But if you zoom out a little bit on the 12-month time frame, and we did some number crunching, very simple, took the average, it just flatlines at 0, while equities, US and emerging markets, real estate are highly correlated, meaning or implying or strongly signaling that Bitcoin really is a great diversification tool in your portfolio. Yeah. Lastly, we put together all of these key metrics and properties into some model portfolios, and with basically outstanding results. You see, as you increase the Bitcoin allocation in a traditional 60-40 portfolio, we took away from the risk sleeve, from the equity sleeve, and put it into Bitcoin. You see your annualized return keeps increasing, and also your risk-adjusted returns keep increasing as well. So there's no better argument to make, and Lynn Alden put it very elegantly, saying the only allocation that doesn't make sense is 0%. And we believe that the entire globe is basically waking up to that fact. Interestingly, I highlighted that bonds kind of suffer or basically face this trust erosion right now. So there's also compelling arguments to make to take some of the bond part of the bond sleeve of your portfolio away and put it into hard assets such as gold and Bitcoin. Now quickly highlighting ETH. So ETH is very important, is a very nice counterpart to Bitcoin. It basically anchors three defining dimensions of the digital asset landscape. It's the most dominant tokenization platform. It leads in stablecoin share, in real-world asset share, which is increasingly important if you think about the recent legislation, Genius Act, maybe the most aggressive legislation across the entire history. We are basically talking about now tech companies competing with banks. We are talking about stablecoins now competing with bank deposits. The second pillar is innovation mode. It also is the leading blockchain network in terms of developer market share, in terms of TVL. And lastly, something that is rather new this cycle, in traditional investment vehicles, it gained a lot of market share. And in market cap adjusted allocations, there's still a gap. So we expect more upside in terms of this cake changing basically to bigger market share for ETH, but also for Solana. Because if you think about it, we have in ETFs now the approval of staking. In DATs, you can think about ETH as a superior asset in terms of its yield bearing compared to Bitcoin, and it comes with a higher volatility. Meaning that these DATs, their financial plumbing, they use a lot of options dynamics, which is very attractive. Quick view at institutional flows in terms of ETH. Yeah. We see, especially from June onwards, picking up. The light red one is basically ETF net flows. The dark red one is DAT net flows. Yeah, we see that these institutional influx of capital is highly outpacing the new supply, displayed in gray here. We now have 10% into the pockets of institutionals across just a couple of months. And one very impressive metric is July alone saw 3 million in ETH demand, basically outpacing the new supply by 20 years. The periodic table for ETH looks like that. What we see quite quickly is ETH manages in some years to outperform BTC, but it also comes with larger drawdowns, basically displaying this higher beta on Bitcoin, and also displaying that it comes with more volatility, which is interesting for investors that are more risk tolerant.
We're not exporting anymore.
If we combine Bitcoin and ETH in a model portfolio, we get better results than just having Bitcoin in a portfolio. We are now at 16.8 with 10% allocation compared to the 16.5. So it's slightly better. And you can view this duo in your portfolio, like Bitcoin could be the monetary anchor, and ETH can be somewhat the yield-bearing asset that can substitute bonds and is untethered basically from fiscal erosion, right? Lastly, some notes to take home. What did we learn today? The sovereign debt doom loop is tightening. Gold and Bitcoin really, in terms of this hard asset rotation, stand as natural beneficiaries. We showed that Bitcoin and ETH are really early in their institutional cycle. Think about the fund managers only allocated 0.4% right now. Bitcoin and ETH both can elevate classic portfolios on multiple fronts. They have like very attractive synergies. What I just mentioned, ETH emerges as this yield-bearing layer where bonds face this trust erosion. So it comes without this fiscal track. And lastly, maybe as you know, in terms of the Fed rate policy, retail rotation, private credit creation is still muted. Retail rotation remains on standby. In our view, the cycle is still institutionally paced. And I want to leave you with this because it's a great quote on how the markets are currently perceived. I read it quickly. Do I buy treasuries when governments owe 38 trillion, corporate bonds with spreads at 20-year lows, stocks trading on a 40x PE, or gold that's just gone vertical? It's pretty tricky, and I think we made a quite good argument on why Bitcoin and crypto assets are quite attractive in this environment. With that, thank you very much.
Thank you, Dominic. Very, very insightful. I have to say, from my perspective, I'm convinced. but maybe
Nice.
I didn't need so much convincing after all.